Pfizer. It's a name we all know, right? They were at the forefront of the fight against the pandemic, a real hero in the healthcare world. But if you're an investor, well, the story's been a little more complicated. Let's get into it.
And this right here is the big question we're going to try and unpack today. I mean, how does a company that had one of the biggest success stories in modern history end up with a stock that has just completely frustrated so many people? It's a real puzzle. So let's start with section 1, a hero's fall, because this is really where the plot thickens. Okay, check this out. During the pandemic, Pfizer's revenue just went through the roof. I mean, it absolutely skyrocketed. The demand for their vaccine and treatments was off the charts. But here's the crazy part. As those sales started coming back down to earth, the stock price didn't just flatten out, it took a nosedive. And that disconnect is really what this entire debate is all about. Because of that performance, you've basically got two groups of investors staring each other down. One side is screaming, this is a massive bargain, a world-class company on sale. But the other side is waving a red flag, saying, whoa, careful, that's a classic value trap. You know, a stock that looks cheap, but it's cheap for a reason, and it might just stay that way. So, to really get a grip on this whole debate, we have to look past the vaccine. We need to pop the hood and see how the whole Pfizer machine actually works. And what a machine it is. You gotta remember, Pfizer has been around since 1849. We're talking over 170 years of evolving, from making basic chemicals all the way to creating blockbuster drugs. This company knows how to reinvent itself, and that's a huge part of its story. And it's so important to get this. Pfizer is not a one-trick pony. Not at all. Yeah, the COVID vaccine got all the attention, but the company is spread out across some really critical areas. They have huge divisions in cancer treatments, that's oncology, as well as internal medicine, and even specialty care for rare diseases. That diversification is there for a reason. It's meant to keep the company stable, even when a huge product, like the vaccine, sees its sales drop off. All right, now that we know the company a little better, let's get to the main event. It's time for the great valuation debate. We're going to break down the bull case and the bear case side by side. So what's the deal here? Is Pfizer a golden opportunity hiding in plain sight? Or is it a giant facing a slow, steady decline? Okay, here it is, the two sides of the coin. The bulls, the optimists, they're pointing to the fact that the stock looks cheap, the company is still generating tons of cash, and hey, that high dividend is really nice. They think the market is just overreacting to the COVID sales drop. But then you have the bears, the pessimists. They're worried about slow growth, the fact that some of Pfizer's biggest drugs are about to lose their patent protection, and the huge risks that come with relying on brand new drugs and billion-dollar acquisitions to save the day. So let's look at what the bulls are seeing. They're looking at key numbers, like the price-to-earnings ratio, which is just a simple way to see how expensive a stock is. And for Pfizer, that number is often way lower than the rest of the market. At the same time, its dividend yield, that's the cash you get paid just for owning the stock, is often much, much higher. In fact, that dividend yield has often been hanging out above 4%. Now, here's why that matters. The argument is that even if the stock price goes nowhere for a while, you're literally getting paid a really solid income stream just to wait. And if you're an investor looking for income, well, that's a pretty powerful argument. But look, a cheap stock is one thing. For Pfizer to really win, it has to grow. And that brings us to the next chapter, betting on the next blockbuster. Because in this industry, the drug pipeline, well, it's everything. And if you're not familiar with the term, the drug pipeline is basically the long, winding road a new medicine takes. It starts as just an idea in a lab, then it has to go through years of intense clinical trials to prove it's safe and that it actually works, and then, maybe, just maybe, it gets a thumbs up from regulators and finally makes it to market. And success is so hard. It's not just one step. A drug has to pass those grueling late-stage trials. It has to get the green light from agencies like the FDA, and then it has to convince doctors and patients to actually use it. And all of that is happening while fending off rivals. One misstep anywhere along that path, and billions of dollars in research can just, poof, disappear. So to stack the odds in its favor, Pfizer is pouring money into really specific areas, like cancer drugs and specialty medicines. Why? Because those areas tend to have less competition and their drugs stay protected for longer. It's exactly why they spent a massive amount of money to buy Seagen, a company that's all about cutting-edge cancer treatments. It's a huge bet on the future. But making that bet pay off is not going to be a walk in the park. There are some serious hurdles to clear. And you can't have an honest conversation about Pfizer without talking about the major risks the company is facing right now. And here are 4 of the biggest ones. First up, the patent cliff. It's exactly what it sounds like. A blockbuster drug's patent expires, and suddenly cheap generic copies flood the market, and the revenue just falls off a cliff. Second, as we just talked about, is the risk that their new drugs just fail. Third is pressure from governments who might demand lower prices. And finally, there's acquisition risk, the danger that you pay way too much for another company and the deal just doesn't work out.
So, after all that, what does this mean for someone thinking about the stock? Let's talk about who this might be for and who might want to stay away. When you boil it all down, Pfizer seems to be a stock that could really appeal to someone with a long-term mindset, a value investor who's looking for steady income from that dividend. On the flip side, it's probably not a great fit for someone who's looking for explosive growth or quick short-term profits. It's a perfect example of how one stock can be a great fit for one person and a terrible fit for another. And this quote from the analysis really just says it all. Pfizer represents a balanced risk-reward scenario where patience, diversification, and long-term thinking matter more than short-term price movements. This is not a get-rich-quick stock. It is a long-term strategic story. Which really leaves us with this one final question. After the incredible highs of the pandemic and the pretty painful lows that followed, is Pfizer a sleeping giant that's about to wake up? Or is it just a giant that's stuck in the mud? Maybe for a long, long time. The answer, well, that's not going to be revealed tomorrow. It's going to unfold over the next few years.